What is your experience of the phrase go to cash? Because if you go to cash, there's a point where you got to get back in. Are we like a 4%, 5% tasteful cash in case one of the kids needs something? Or are you like 40 or 60% in cash?
Yeah, so that's a great question. So first of all, look, I run equity mutual funds. I have to stay relatively invested, but we adjust the beta in our portfolios. And what has so worked here until recently is high beta, especially high beta reopening value stocks. So I think at this juncture, what we're starting to see, Tom, is that value stocks are continuing to work, but not high risk value stocks. It's the safer value stocks, some of the higher quality financials, industrials, even some of the energy. I think you want to adjust the risk down. Now, in terms of going to cash, look, I think it'll be a good month because I do think the quarterly earnings will be good. But I think having cash on hand so you can capture if we do have a 10, 15% correction, which I think is coming at some point this summer, you want to be a buyer into that. So you got to have some cash available, to capture that.
I mean, John, I think this is so important. The definition of a correction, 10 or 15%, a bear market, 18%, and the oops of a negative 35%. We tried to go down to correction here a number of months ago. Didn't get there.
Saw it a little bit on the Russell, I think, Andrew, just to jump in. I find it really interesting, Andrew, that we're talking to people like you. I've had the same conversation with BlackRock that maybe have a cash allocation. Volatility is going to pick up through the summer as we start to have this tug of war, this big debate over inflation as the data comes in. Yet volatility just keeps declining. We keep chipping away at the VIX, Andrew. Why do you think that is?
Because the economy is reopening, John. Because the VIX has remained elevated versus pre-pandemic. Pre-pandemic, it was in the mid-teens. It's remained above 20 for a year. It only finally has broken back to pre-pandemic levels, and I think that's consistent with consumer confidence is now coming on. The economy is reopening and things are getting back to normal. You want to be invested and being optimistic when people are cautious, right? I'm sure people have been coming on this show for a year now, John, saying, well, I expect more volatility in the future. Well, that's because they're looking in the rearview mirror, right? Now you don't hear people talk about more volatility because there hasn't been a lot of volatility lately. You want to be more cautious when the coast is clear, when the green lights is flying, it's all safe to invest. And that's what the VIX is telling you now. And that means the market can't withstand bad news. When the VIX is elevated, people are expecting bad news. So bad news like a re-outbreak last fall didn't cause a big correction. That's the key here. I want to go back to this cash level if you have a moment, because I think it's a really important concept, which is, yes, we had a big correction last year, obviously, but 20% more corrections are very rare. So if you have cash on hand and you invest, say, down 5%, you add more down 10, add more down 15, the odds are you're going to be well rewarded over time by investing into weakness in the market. So I'm a big believer in a very, kind of algorithmic way of, unemotional. When you get pullbacks, you automatically put more money into the market because the odds are they're going to stop, down at that level. And I think that's what's going to happen this summer.